Since the beginning of the year, a vast number of news outlets have been stating that the biggest crash in the history of the world is here with us. But they just picked it along quite late, because Robert Kiyosaki, the author of Rich Dad Poor Dad, was blowing the trumpet way before 2022. And this time around, he's here to tell us to buckle up because we are still a long way from being done. Actually, Kiyosaki claims that whatever we are facing is just the beginning. We still have a long way from recovery. So, do you think the economy is going to fall any lower than this? Hello and welcome back to Crypto Cash Channel. What's your thought on the current state of the economy? And which way do you think we are headed? In today's video, we look at how Kiyosaki is predicting the downfall of America. But, first, before we go on, a sub to the channel would be very appreciated. Comment, share the video, and don't forget to leave a thumbs up for the video. Let's get into it. For starters, Kiyosaki believes that a result of the crash is that it will destroy shares, property, gold, and Bitcoin. Then to what extent should you be concerned? If Kiyosaki is right, then it doesn't matter if you have assets or not, your net worth will definitely go down. And if you go looking for what might happen in an economic collapse, there's a lot you should be concerned about, as the well-known author, fund manager, and former professor of finance Glenn Arnold pointed out around the end of last year. Earlier this year, Kiyosaki pointed out that the surging prices of homes all around the world, the unsustainable levels of borrowing, and the looming possibility of a bubble in the cryptocurrency market might combine to bring about a disaster. And now in July, we seem to be living in the light of his prediction. But still, Kiyosaki is voicing that there would be a big stock market tragedy in the future. It didn't take long for FinTwit to point out that this isn't the first time in the past decade that Kiyosaki has forecasted a huge drop in the market. Kiyosaki tweeted in March that the Federal Reserve and the administration of President Joe Biden wanted to utilize inflation as a trade-off for the trillions of dollars in debt that the United States owes. And fans of Robert Kiyosaki's book Rich Dad, Poor Dad have recently shown an increased interest in a fresh set of predictions and guesses that he has made concerning the United States currency and cryptocurrencies. He has forecasted the collapse of the US dollar. According to him, the confrontation between Russia and Ukraine will trigger a rise in the popularity of cryptocurrencies, and as a result, people will be less likely to use the fiat money issued by their government. And in a tweet that was published in March on his social media account, Kiyosaki mentioned Bitcoin. Kiyosaki offered this explanation in reaction to problems that have been facing the Russian ruble, saying that many people in Russia are now betting on Bitcoin. Kiyosaki has already indicated that the Biden administration and the Federal Reserve intended to utilize inflation as a trade-off for the trillions of dollars in debt that the United States is now in. But still, he elaborated on his previous remarks by stating that the best way to invest right now would be to splurge on assets such as gold, silver, and Bitcoin. In a further remark that Kiyosaki made about oil, he highlighted how he never invests in oil businesses or organizations and instead chooses to purchase the real reserves. He asserts that investing in companies such as Exxon carries fewer risks but results in lower earnings overall. In recent months, Kiyosaki has cautioned his readers by claiming that people all across the world are currently living in a gigantic bubble of ignorance. In addition, he stated that the government of the United States plans to assume control of all crypto assets and regulate the whole sector on its own by means of a Fed crypto. This assertion was met with much pushback from readers, many of whom pointed out that the vast majority of cryptocurrencies run on decentralized networks, which are notoriously difficult to control and hence not feasible how to control. But why is Kiyosaki confident that the dollar is going to lose? According to Kiyosaki, the owners of Saudi Arabian oil businesses are mulling over the idea of accepting the Chinese yuan as payment for oil shipments to Chinese customers rather than the United States dollar. And in spite of the fact that Kiyosaki's forecasts could appear to be exaggerated to some extent, a great number of people have recently made public statements concerning the depreciation of the value of the US dollar in the wake of the conflict between Russia and Ukraine. Jim Rogers, an experienced investor who helped form the Quantum Fund and is now a co-founder of the fund, has remarked that even if a global currency is thought to be neutral in any dispute, regulatory requirements are evolving. But what are the experts saying? According to a survey conducted by the Financial Times, almost 70% of prominent academic economists expect that a recession will hit the economy of the United States in the coming year. According to the most recent study, which was carried out in conjunction with the Initiative on Global Markets at the University of Chicago Booth School of Business, the Federal Reserve is increasing its efforts to limit the greatest inflation in approximately 40 years. One of the most rapid rounds of monetary policy tightening in decades has already begun at the Federal Reserve in the United States. It had been near zero when March rolled around, but since then, it has increased its benchmark policy rate by 0.75 percentage points. According to the forecasts of nearly 40% of the 49 respondents to the survey, the National Bureau of Economic Research will officially declare a recession in either the first or second quarter of 2023. According to the results of the survey, 1/3 of people believe the decision will be postponed until the second half of next year. And now, how about we take a look at the polls? What do they indicate? The findings from the poll that was conducted between June 6 and June 9 contradict the argument made by the Federal Reserve that it is possible for them to reduce demand without having a substantial negative impact on the economy. According to the central bank, when interest rates rise, businesses in the red-hot U.S. labor market would prefer to cut the number of job openings rather than lay off people. This will have the effect of slowing the development of pay rates. In an interview with the Wall Street Journal, the chairman of the Federal Reserve, Jay Powell, described the current economic climate as having a softish landing and predicted that unemployment would increase by a few ticks. Many of the economists who participated in the poll are concerned that in order to combat the severity of the inflationary situation, monetary policy may have to be adjusted to a substantially more stringent setting in a very short amount of time. When the findings of this month are compared to those from February, it becomes clear that an increasing number of analysts are of the opinion that the annual rate of inflation for personal consumption expenditures will exceed 3% by the end of 2023. 12% of those questioned in June thought that result to be very likely, up from only 4% earlier this year who believed it to be very likely. Since then, the proportion of economists who responded to a survey saying they believed reaching that level was unlikely within the same time period has nearly halved. So, will inflation keep rising or falling? It is possible that geopolitical tensions and the anticipated rise in energy costs that come along with them, together with lengthy supply chain disruptions, could keep inflation at a high level throughout the course of the next 12 months. It is anticipated that core inflation would have increased by 4.3% by the time the year ends. Jonathan Wright, an economist at Johns Hopkins, said that the current state of inflation and growth is reminiscent of the infamous stagflationary conditions that plagued the United States in 1970. However, he added that the situation is much worse than it was back then because there is a much worse mix of high inflation and recession. If the Federal Reserve only hiked the federal funds rate to 2.8% by the end of the year, over 40% of economists projected that it would not be enough for the Fed to successfully manage inflation. Therefore, rate hikes of half of a percentage point will need to be executed over the following 3 meetings of the central bank, which will take place in June, July, and September, before the cadence is decreased to its more usual quarter-point cadence for the final 2 sessions of 2022. So, how should we anticipate the next few months to unfold? Professor Christiane Baumeister of the University of Notre Dame anticipates that the Federal Reserve will raise its benchmark policy rate to as high as 4% in 2023, if not sooner. And the majority of economists believe that the tightening cycle will reach its peak in the not-too-distant future, which is just above that. And that's all for today's video. Thanks for watching. Do you believe the predictions that Kiyosaki is giving? And will things keep worsening? Comment below. Let's engage. Also, if you are interested in more videos like this, make sure you like this video and subscribe to our channel. Don't forget to turn on the notification bell for more amazing videos. See you in the next video.